Today, we are talking about China and its property market. Uh, to be honest, I'm quite surprised by the poll results because China has been, it may sound risky or counterintuitive to some of you given the media headlines that's been all over the press in recent times. But I hope that today's session can provide a different perspective that would help you make a more informed decision. So let's take a quick look at the agenda. In order to think about investing in China, it is important to put China in perspective with the rest of the world because China represents only one investment option to investors. Hence, we need to talk about the market overview. Then we'll review the investment options available to investors and why specific asset classes and products are much more attractive in the current environment. With that, it is easier to put China in context and why we need to think about China. And then finally, we'll touch on China property, which is a strategic sector within the Chinese market. So, with that in mind, let us start with the overall market in this year. I think it's clear to everyone that the markets have not been doing well this year against the macro headwinds of Ukraine crisis, persistently high inflation, the lingering after effects from COVID, and the ever changing US and China trade relations. All of this has weighed on the markets, and markets have declined across the board globally. All geographical regions are down year to date, and most asset classes are down as well across equities, fixed income, and even crypto is not spared from this downturn. And the market is telling us that we have yet to hit the bottom. Here, we have the implied interest rate curves for the two largest economies in the world, US and China. For US, the market is pricing in Fed hikes up to 4.7%. The current range is around 3 to 3.25%. The Fed has reaffirmed its stance to tackle the high inflation and to bring it back down to the 2% target. So that means we are still looking at around another 1 to 1.5% worth of Fed hikes. Now, this has resulted in an inverted yield curve, as you can see from the chart on the left. The inverted yield curve historically is a leading indicator of economic recession. And the current consensus is for US to enter a recession by next year or as early as December this year. China, on the other hand, is facing a different set of problems. It started with COVID in 2020, a slew of policy restructuring in 2021 affecting main sectors like tech and property, and of course the zero COVID policy this year, which has been dragging on the economy. This is why the market does not expect China to achieve its GDP growth target of 5.5% this year, even though the government has been actively implementing measures to stabilize the market and to stimulate the economy. Having said that, the market's revised GDP forecast for China at 3.3% this year and 4 plus percent next year is still among the highest in the top 10 economies globally. And how is the stock market reacting to these developments? The US S&P 500 has dropped around 23% from the peak in December last year, but note that it is still trading at a premium versus the pre-COVID levels back in March 2020. In the context of a lower growth outlook and reduced liquidity from Fed tightening, the downside risk in US is still significant today. And the IMF has told CNBC that US stocks could drop another 20%, and so far is held up because of the positive sentiment. But once this changes, the market could react swiftly. On the other hand, China has corrected way back in 2021, triggered by its policy announcements. The stock market has corrected 34% from its peak, and it is already trading below pre COVID levels, which makes a lot more sense from an intuitive level. In short, the stock markets have corrected, but they may still be downside risks. So it may still be too early to start averaging down at this point. And most people think that if you hold on to the stocks long enough, you will eventually make money in the next market cycle because the stock market is upward sloping over the long run. But this may not always be the case. Even if you think you can afford to withstand the upcoming downturn in the market, but what is more scary than the markets falling further? The answer is, what if there is no rebound? And this has happened before. If you look at Dow Jones as the proxy for US market in the chart here, essentially US market traded flat from 1968 till 1982. Or if you held a US stock portfolio from 2000 till 2010 without touching the stock portfolio, your realized returns might be lower than you think because the market actually ended flat over that decade. The subsequent decade from 2010 to 2020 was a fantastic run, one of the best in the history of stock markets. But that is because we had the most accommodative Fed policies in history in the aftermath of the 2008 global financial crisis. And now we no longer have the luxury of that liquidity support because the Fed is tightening in order to fight inflation. Along the same lines, the story is not so different for fixed income. Although it should be said that the yield from fixed income instruments has been rising in line with the rate hikes, but this is also offset by downside risk from the impending rate hikes that the Fed has been talking about. But it would certainly help to have some exposure to fixed income to generate yield. Some of you may be generating yield from REITs, but note that REITs are similarly exposed to downside risk when the economy goes into recession. But as in fixed income, timing is paramount. When is the right time to enter? And that brings us to the second segment. If it is all doom and gloom in the public markets, what on earth can investors do right now? What can you do to improve the returns in your portfolio or to reduce the risk? The answer may lie in the increasing trend into alternative asset classes and products. An alternative investment is a financial asset that does not fit into the conventional equity, income, or cash categories. Some examples of alternative investments include private equity, private debt or called private credit, hedge funds, real estate, infrastructure, amongst others. There is strong evidence suggesting that the institutional investors, family offices, and ultra high net worth clients have been reallocating to alternative investments from the traditional equity and fixed income space. This is probably in response to the deteriorating risk reward that is being priced into the public markets right now. Academic research has also shown that exposure to alternative investments improve the overall risk reward profile of a portfolio beyond a traditional diversified portfolio in equities, fixed income, and cash. Now, in the past, it is not that easy for the average investors to access these alternative products because they are usually accessible only by investors with a larger portfolio or institutional investors due to its relatively more illiquid profile and generally longer investment horizon. Today, fortunately for most of us, this gap has been addressed by innovative solutions like SDAX, where they are able to disrupt the traditional investment landscape and make this kind of alternative products easily accessible to all of us via a user-friendly platform. So I would encourage all of you to give serious thought to alternative investments because it will improve the efficiency of your portfolio in the current environment. With that in mind, now let's dive into our main topic today, China. We need to talk about China because it is the second largest economy in the world. And there are research that show that China may overtake US as the largest economy in the next 10 to 20 years. China now spends more of its GDP on R&D than many European countries. China invests a higher proportion of GDP than any major country in recent history into housing, infrastructure, manufacturing, tech, healthcare, and the likes of those. This provides the fundamental pillars to domestic economic growth. And we all know that the Chinese government has been capable of deciding on policies and implementing them in a much more efficient and effective way than a lot of Western economies, where the bills may be debated in parliament for a long time and subject to the influences of many lobbying groups with conflicting interests. And this week, at the 20th Five-Year Congress, Xi Jinping will most likely create history by renewing his third term as president. It is also very well known that China intends to grow into a global powerhouse to rival the US. And in order to achieve that, the government must ensure that the economy has to continue to grow. And President Xi Jinping has renewed his pledge over the past few days to grow China into a medium developed country by 2035. This implies a doubling in the size of economy from the 2020 levels, which implies a GDP growth target of 4.7% per annum for the next 13 years. This means that the government has to be more proactive in stimulating the domestic economy and wooing foreign investors and capital into China. Then we come to the property sector, which is a strategic sector responsible for driving the economic growth over the past 20 years. There has been all kinds of media reports on China property sector over the past 12 to 18 months, and most of them are negative headlines because there is no news like bad news. However, the problem may not be insurmountable. For example, there have been many articles about the mortgage boycotts in China from disgruntled homeowners due to the uncompleted projects that arises because of the developers who ran into cash flow problems. Now, S&P estimates that the loans at risk from these mortgage boycotts are around 1 trillion renminbi. Although this sounds like a big number, it only accounts for 2.5% of all mortgages, or a very small 0.5% of all loans. Regardless of that, the overall sentiment has been cautious on the ground, and S&P estimates that the China home prices will fall 6 to 7% this year. Now, this price correction is not surprising. In reality, the orderly decline is actually in line with the government's objective of cooling the property sector and curbing excessive leverage in this sector. But the underlying demand is still intact. Even though the China's unprecedented home building boom over the past 10 years is now a thing of the past, there is still fundamental demand for housing. China's urbanization rate right now is around just over 60%. This is comparable to where the US was in the 1950s after World War II. And it still has a lot of room to grow. And there are reports that suggest that there's an estimated 10 million people set to move to cities each year for the next 3 to 4 years. And this domestic migration patterns will set the base or the floor for demand for housing properties in the tier 1, tier 2 cities. So even though there have been a lot of negative headlines around developer defaults or mortgage boycotts, there is no fundamental breakdown in the demand supply factors in the market. What the market is really concerned about is the slowdown in the property sector and the cash flow issues faced by the developers. Will this evolve into a widespread debt crisis that could potentially derail the entire economy? And in order to answer this question, we have to look at the China banking system. Some of you may be surprised to know that China's banks are bigger than the US banks now. In fact, uh, across all the surveys of the largest banks globally, within the survey, the largest US bank ranked by assets is JP Morgan. And JP Morgan only ranks number 5 on the list. The top 4 spots are taken by the big 4 Chinese banks: ICBC, CCB, ABC, and BOC. So when you compare China versus US in this survey, there are 140 Chinese banks that made the top 1,000, and there are 186 US banks that made the top 1,000. However, the 140 Chinese banks have more than double the tier 1 capital and almost double the assets of the 186 US banks. And as a testament to its size, ICBC has ranked number 1 in this poll for 10 consecutive years. As a comparison, Singapore's largest bank, DBS, ranks number 68 in a similar study done by S&P this year. So the data here suggests that the China banking system is large. It is immense, and research suggests that the banking system is able to contain the current debt issues faced by the developers or the mortgage boycotts from the affected home buyers. Even so, looking beyond the banks, the government has also been actively implementing policies to support the market. Now, this slide lists some of the many government initiatives in this year alone. There are the standard rate cuts in key loan rates and triple R, the liquidity injections into the system, special loan arrangements for developers, financial support to consumer mortgages, etc. And state-owned enterprises, SOE for short, they have also been tasked to support the market by taking over the development of uncompleted projects, assist in the balance sheet restructuring of the troubled developers, and streamlining the mortgage approval process for consumers. So I think when you go through these measures, it is evident that the China government is actively supporting the market. But the same cannot be said for the other markets like US and Europe, etc., where their governments are still actively trying to bring down inflation, even at the cost of economic growth. So, in summary, let's do a recap of the facts on China. It is the second largest economy in the world. China has corrected in 2021 before the rest of the world has even started their downturn. China has corrected more than the G7 economies, and this implies that, all else being equal, there is lower downside risk from the current levels. China's GDP growth forecast is still among the highest in the largest global economies. And most of its major policies and events are well publicized. And by that, I mean all the bad news like zero COVID, developers default, policy reforms, mortgage boycotts, all of that. So what this means is most of the bad news are already reflected in the price. The government is committed to support the economy and stimulating growth, as we can see from the previous slide with all the measures. And the central bank of China is easing while the rest of the world is tightening. This implies diversification benefits from a portfolio context. And finally, I want to remind everyone that China has currency control measures. Most of the liquidity and wealth of the country is trapped onshore. Plus, the government is stimulating the economy by pumping additional liquidity into the system. So, where can all this money go? Historically, the financial market and the property sector have been the main beneficiaries because only these sectors are large enough to absorb the liquidity. And we do not expect this to change. So, in conclusion, we think that China has went through a slew of corrections and policy restructuring and a lot of negative publicity, but most of this is already out in the news, and the market has shown that by when its correction is more than the rest of the world. So with China dropping so much, the downside risk may be more limited than the other developed markets, which means it may be time to start relooking at China again.